This is Agriculture Today, and I'm Samantha Bennett with the K-State Radio Network. Today's show begins with a two-part segment on the current economic environment with K-State professor in the Department of Agricultural Economics and the director of the Arthur Capper Cooperative Center, Briggeman. In our first segment, we discuss the history of rapidly rising interest rates to combat inflation, the current labor market, and consumer demand. In part two, Brian continues the conversation, but this time focusing on the impact everything we discussed previously will have on agricultural producers. For this week's horticulture segment, K-State horticulturalist Ward Upham looks at past research from K-State's John C. Pear Horticultural Center on the effect of controlling grasses around newly planted trees to get the best possible growth. That and more is coming up ahead on Agriculture Today. This is Agriculture Today. We are joined now by Briggeman. He is a professor in the Department of Agricultural Economics here at K-State, and he also serves as the director of the Arthur Capper Cooperative Center. So, Brian, thanks for first and foremost being here today.
I appreciate the invitation, Samantha. Looking forward to the discussion.
Absolutely. So, you're here today to really discuss with us the macro lens of where we are currently in the U.S. economics-wise. There's a lot going on, obviously. We talk about it a lot in our cattle market and our grain market updates that we do every week here on the show. But it'd be great to have you share kind of some of your perspective of where we are currently in the U.S. economy. I feel like this R word keeps being thrown out, recession. Is it coming, or are we needing to be preparing for that?
Right. Well, that is the million-dollar question, right? Like, what's coming at us? Are we going to hit into a recession? So if we look at where we're at from the U.S. economy, from a measure of gross domestic product, so the value of the goods and services we produce within the U.S., coming off of the COVID-19 pandemic, we had some growth, but 2022 was a year where it really stagnated. And in fact, the first two quarters of 2022 had negative growth. Then it came up, and right now it's pretty low as well. And a lot of economists are forecasting very small growth or a decline. There's a lot of uncertainty out there, and a lot of people don't agree right now. So many economists feel a recession is coming here in 2023. I would include myself in that camp as well. A big reason why, when I look at the market and some of the leading indicators of a recession, you look at the U.S. Treasury yield curve. So without getting into a lot of the complexities of the yield curve, what we're looking for in it is whether or not it is inverted. So if a yield curve is inverted, what it means is short-term interest rates are higher than long-term interest rates. And when that happens, what the market is saying is that something is amiss right now, and we would expect the Fed is going to have to lower rates sometime in the future to help spur growth. And as we all know, what's been going on is the Fed has been increasing interest rates very rapidly. And when the Fed does that, it's short-term rates. And they're doing that to fight inflation. But when the market looks out ahead, those short-term rates are well above the longer-term rates. And if we look over history, when that occurs, an inverted yield curve, it bears out that a recession does happen. It's happened since the 70s, through the 80s, the 90s, the 2000s, like right before the 2008 financial crisis, yield curve inverted. And today, we're firmly in that position. So many people are anticipating a recession to happen, myself included here in 2023. It's likely, but the question kind of bears out like, well, how bad will it be, right, if we do have one?
Absolutely. And, you mentioned a lot of stuff revolving around interest rates right then, and the Fed has obviously rapidly increased those, and it's been to help combat this. So there's a history behind that, right?
Right. So the Fed is raising interest rates for a very specific reason, to combat inflation. For the first time in decades, inflation has been on the headlines. We haven't seen it in a very, very long time, and now it's on the newspaper front page. It's on Twitter. My students are aware of inflation. Everybody knows about it. about it. And the Fed is going off of experience, really, to combat it. So they have increased their interest rates, the Fed funds rate, or the rate that banks lend overnight, from the zero bound all the way up to where it's trading between 4.25% and 4.5%. And the Fed has prepared the market for this year for it to go up another percent.
Wow.
Now, what does that mean for us to be thinking about? Well, on variable interest rate financing we might have, it might go up another percent. Now, the Fed has kind of tempered that a little bit in their most recent reports, but still the market is anticipating maybe some additional increases on that. So why are they doing it, right? Why such a rapid rise to combat inflation? Well, the Fed is looking back in history. They learned a really important lesson that in the 1970s, when we had rampant inflation, when inflation was very high, double digit, where we've had inflation get up to around 8%. I mean, inflation numbers were 12%, 13%, much higher than today. And what led to that high inflation was what's called the wage price spiral. So as the labor markets during that time were uneasy, weren't the best, and what businesses needed to do was to increase their wages to attract workers to come and work. Well, they would get higher wages, workers would come in, but businesses would then pass on that higher cost as higher prices. And so prices go up on the goods that they would sell. So then these workers who are making higher wages, when they go spend that money, they're having to pay a higher price. So prices went up. So they need to demand a higher wage so that they can pay for these more expensive goods.
This is sounding familiar.
Yeah, exactly. It kind of starts to repeat. Wages go up, then businesses have to increase prices yet again. Then workers need more money, wages go up, prices go up. So that's the wage price spiral where things just spin up, really spin out of control if you want to think about it that way. And the way the Fed finally ended that wage price spiral was letting interest rates rise well into double digits, much, much higher than what it is today. So that's the Fed's fear, is that we can't have that happen again. We need to let interest rates rise very rapidly to combat inflation.
So they're anticipating that right now is kind of what they're doing. It's a, like you said, combative is kind of the word that you used earlier.
Yeah. You know, when you let interest rates rise, as the Fed has done, it hurts the whole economy. It slows everything down. And when we think about what the market anticipates, those higher rates, if the Fed does cause a recession, well, what does the Fed do in a recession? Well, they lower interest rates. So that's where the inverted yield curve kind of ties into the story about, you know, the anticipation of a recession happening here this year.
This history you were telling there, I said it sounds familiar jokingly because we're kind of seeing it now with our labor markets, right?
Yeah. So the labor markets, one of the things the stories always like to tell, I was in Colorado over this past summer and driving around, and you see a McDonald's sign that has an hourly wage on it, and it was very clear that it had been taped over as a higher price, right? A higher wage. And I asked myself, how many times have they had to put up a higher wage just to incentivize people to come to work? And when you look at those wages, nominal wages don't account for inflation. They are on a very steep rise. I work with a lot of cooperatives across the state of Kansas, across the U.S., talk to a lot of agribusinesses, and it's a challenge to offer a high enough wage to compete, especially, say, for truck drivers, for example. So they're having to increase those wages, but when you account for inflation, the ability for those workers to go spend that money, inflation erodes your purchasing power. And so real wages that account for inflation, they haven't kept up. So we're in that challenge right now where we have a tight labor market. So we have plenty of jobs, just not many people come to work. Part of that story is wages that are not there. So if we think about a recession that could happen, maybe it'll be a little bit more mild because there are a lot of jobs still out there. We're seeing some companies cut back on jobs, but it's not the blue-collar jobs. We haven't seen that. So there are jobs out there. Hopefully, we'll get people working again so that we can pull the economy out.
You mentioned changes in consumer purchasing habits there a little bit, and we're seeing that in our markets play out every single week pretty much. I talk to our cattle market economists every single week, and they always, mention a peek at where consumer demand is currently at. And it seems like meat is one of those things that tends to be the first to get knocked off the list, that and eating out.
Right.
So we're kind of seeing the impacts right now on that, right?
Yeah, and we're starting to see some consumers begin to pull back on that slightly. We didn't, at least at the end of 2022, as the data comes in, we haven't seen real sharp declines, for example, on retail sales, right? But we have seen it start to push down. Once you start eating out or have a taste for going to the grocery store and buying meat or buying retail, it's hard to stop that purchasing, right? But we're starting to see some of that demand begin to slip. The question is, like, how far will it go down as we progress through 2023, especially if a recession happens?
Lots to still come, obviously, as all of this plays out. It's a complicated issue, but that's why we have you here explaining a lot of it to us. And we were talking about interest rates earlier and what has been done to hopefully help combat the inflation that we're seeing. But are we seeing that this is going to be enough to actually stop what we're seeing, or are we about to plummet, do you think?
Well, if you look at what the market tells us, the market suggests that future inflation is under control. We look at break-even inflation rates on a 5-year, 10-year rate. They have come down to about 2%. That's what the Fed wants to target inflation to be. So the market at least feels that inflation is beginning to get under control, but we have to see it bear out in the data. So the market, that's what their expectation is, but how are businesses looking at price increases, grocery store, energy, all those things, wages, rents? Will the data bear it out? So the Fed has been ready to increase interest rates pretty rapidly again, but some of the stuff coming out, as I mentioned before, you're starting to see the Fed maybe kind of temper those expectations a little bit. Is that enough? I mean, only the future will tell us that, and I truly wish I knew, but unfortunately I don't know. When we look back over history, that wage price spiral, one thing we do know for sure is that we cannot get caught in that trap again, because that created a double-dip recession, created a lot of stress for businesses, and also, too, for agriculture as well.
Absolutely. Well, Brian, this conversation isn't going to end here. I know we're stopping and pausing here for a short break, but we're going to continue on in our next segment as well. So thank you so much, and we'll be back with more.
Sounds great.
Wonderful. Once again, that was Brian Briggeman. He is a professor in the Department of Agricultural Economics here at K-State. We'll be back with more ahead on Agriculture Today. This is Agriculture Today. We are back again now with Brian Briggeman. He is a professor in the Department of Agricultural Economics here at K-State. We just finished up our conversation on kind of the macro lens of economics right now, inflation, interest rates rising, things like that. But now we kind of want to tie it back into where we sit at with all of this going on in the world of agriculture.
Yeah, that's a great question, because it's important to look at the macroeconomy, have an understanding of what is all going on. But at the end of the day, what does that mean for us in ag, in rural America, out across Kansas? So for me, when I think about the macroeconomy and ag in generally agriculture holds up fairly well through recessions. The 2008 financial crisis, when the world was in financial markets were seizing up, things were just not going very well. If you looked here in the rural parts of America, we had cranes that were operating and still saw buildings being built. From an agricultural standpoint, it was difficult for a while, but once we made it through that, we had some pretty profitable years. Land values held up. So even though when we look at the outlook for this year of a recession coming, I don't think it's necessarily all doom and gloom for U.S. ag producers and ranchers. So I think looking ahead, there's going to be some opportunities, certainly some challenges that the macroeconomy brings us.
You mentioned land values there, and I think that's something automatically people start thinking about. That's such a huge area of investment, right, that anytime there's even a slight decline in the value of those, it raises some alarms for a lot of people.
And with interest rates rising as rapidly as they have, many stories that I read within agriculture would point to concerns about the land value market cooling off, if not even going down. And many of those kind of projections or expectations are well-founded within financial models that would look at as capitalization rates increase, that puts downward pressure more on our land values. And certainly that could happen. Today, though, I wouldn't make that my prediction. I would not expect, land values leveling off. I think there's still enough momentum to where land values could continue to rise. Maybe not at the rate that they had in the past, but I certainly wouldn't predict land values to go down. So why is that, right? Well, one, 2021 and 2022 were phenomenal net farm income years for producers in Kansas, producers across the United States. They have really built up their balance sheets. Working capital positions are exceptionally strong right now. You go out and talk to different grain elevators, the amount of deferred grain contracts that are out there are tremendous. We don't need the income right now, one, for tax reasons and all that, but also, two, we're okay. Mm-hmm. So producers are in a great position that if land were to come up for sale, they can make some strong bids on them. Now, is that going to be the value going to be supported by the future income? No. But we've looked through these land markets for the last 15 years. I don't know how many presentations or producers I've talked to where they're scratching their heads asking themselves, how is that going to cash flow at those values, yet they continue to have? Well, part of it is these land investments, the appreciation in ground that we've had, it's been tremendous. So the cash buyer that is out there, they still exist today. That's one of the reasons why I wouldn't expect, land values to go down much. And also, too, we haven't heard from a lot of producers that have really balked at the increase in the interest rates as from a fixed interest rate or even variable rate. We haven't hit those really high levels. In fact, publication out of the Kansas City Fed recently showed that fixed interest rates on real estate loans are now just really reaching the average that they were from about 2006 to 2020. Yes, they've gone up rapidly, but we haven't hit those really high rates. So at least for me, when I would look at farmland values going forward through 2023, are there headwinds? Absolutely. But I think the financial condition of the overall industry, looking where interest rates currently are, I think that looks to be, some support for the farmland market.
Great. Well, good news. And you mentioned net farm income. We've had, like you said, some pretty good years. Obviously, producers have faced some challenges, and a lot of those prices that they've seen have become associated with the drought that we've been experiencing. Right. But when they have had crops, it's been a great year for some of these producers. Certainly,
with 2022 being a very good year, it also depends on how much were you affected by the drought. Although some of those producers, we have crop insurance not hitting those real highs, but 2021, 2022 overall for U.S. Ag have held up. But what about 2023? We have seen some input costs have kind of come back a little bit. Commodity prices on our output grains are looking okay, but there's still a lot to find out. Like, what's going to happen in South America? We still need to figure out on export markets, some of the slowdown that we're reading about in China. Will we continue to have exports like what we've had in the past? So there is, without question, a lot of uncertainty. If it was me sitting in the chair of a producer, I don't think I would be projecting the banner year of 2021, but rather, go back, look at the historicals, look at where prices are, and figure out how are things going to go for me and how do I position myself. So I certainly would anticipate net farm incomes in 2023 to come down, but to pin it down on an exact percentage decrease, I'm not for sure what, but in ag, we always have that reversion to the mean, and we've been above the mean for the last 20-year average. We've been well above that average. So we would expect that to come back.
I feel like whenever we do have these really good years on income, we tend to get a little bit more and more comfortable. So as we anticipate potential decreases in 2023 on those incomes, what can producers really control now to help combat that or prepare for it, I guess?
That's a great question because you think about all these big topics and these big issues like what's going on in China and the Brazil crop and federal policies. All of this, like at the end of the day, producers really don't have a good say over that, right? So the advice I always like to leave producers with, control what you can control. And the number one thing is put together a budget. Put together a good budget for your operation. look at it, base it off of historicals, look at where your planting are at, what you're looking forward to in the coming year. What are the positions you have on fertilizer? Have you locked that in? Do you have that coming in? What about on the crop side? Are you doing any hedging? Are you going to do any all that? Set down and put together your budget for the year. But as we all know, when you have that budget, it's going to change, right? So I always like to encourage producers, do some straightforward stress tests. Increase your input costs by 5%. Increase them by 10%. How does that affect your cash flow? How does that affect the budget? What changes could you do if that did happen when you look at that bottom line number of saying like, oh, okay, I see how that would happen. So just some real straightforward changes that you can make. Your interest rates on your operating loan, right? What if variable rates went up 1.5%? How are you going to navigate that? So to have the discipline to put together a budget, know your break-evens, understand where those are at, and then put together just some straightforward stress tests can really help you navigate an uncertain environment.
Absolutely. I think about all of the inputs that producers have to deal with when they put together budgets like this, and it's enough to make my head spin. So I feel like they don't get enough credit for the work that they have to do every day with that sort of thing.
There's a lot of work that goes into it.
Some encouragement for y'all out there when it comes to setting your budgets and putting it to stress tests like you recommended. Right. Great advice for sure, seeing what can give and what can't.
Right, for sure.
And you mentioned balance sheets earlier, and I feel like that's a key area for this too, right?
Right. So when you're heading into this uncertainty, and many people like to bring up, is this like the 1970s, like what we talked about in the last segment, the wage price spiral, or interest rates going to really go through the roof? And then we all at least know about or have heard stories about how terrible the 1980s farm debt crisis was and like all the things. I don't want to go through all of that, but think about for us today, what are some of the lessons we can learn from that for how we can get through a turbulent environment? And, it's not the exciting topic, but it's the blocking and tackling of business. Things that help producers get through that time of the 80s, we need to be implementing here today. And as you said, the balance sheet is one way. So build your balance sheet. Focus on working capital. Build up your liquidity. Build up that current assets, those cash, to be above what your current liabilities, those short-term obligations, because that is the funds that you would have available to you to get through a stressful environment. And certainly I know many of our producers that had a tough year in Kansas in 2022 with the drought. Many of them had built up working capital positions coming off some previous good years. So right there is a big lesson about build up your balance sheet, focus on liquidity. The other aspect of your balance sheet is to use debt wisely. I mean, even though interest rates have come up, historically speaking, debt is still affordable. It's still a good source of capital to help you navigate today's environment. Don't just feel that interest rates are going up immediately. You have to pay cash for everything. No, there are lenders out there, agricultural lenders from commercial banks, the Farm Credit System, credit unions. They're all out there to be partners with you to help you make better decisions. But use it wisely. I mean, certainly that's something you want to look into your budget and forecast. So that building the balance sheet is one way of the blocking and tackling you can approach the uncertainty.
Absolutely. Now is not a time to be taking huge risks, but working efficiently and diligently, definitely key here.
Yeah, absolutely. You want to pour over your operation. Find ways to extract organizational efficiency, operational efficiency, and it's not just costs, right? Certainly you want to be mindful of your costs, but how could I use this asset in a different way? Or, maybe this asset that I'm spending time with, it's not really generating the return that I need, and I need to cull it. So pour over your operation. Find ways to just drive efficiency.
Well, Brian, you have given so much great advice today and provided such amazing insight. I cannot thank you enough for the discussion we've had.
Yeah, this has been great. Thanks, Samantha.
Yeah, absolutely. Thank you. Once again, everyone, that was Brian Briggeman. He is a professor in the Department of Agricultural Economics here at K-State, as well as the director of the Arthur Capper Cooperative Center. We'll be back with more ahead on Agriculture Today.
You're listening to Agriculture Today over the K-State Radio Network. Along with Samantha Bennett, I'm Jeff Wickman. Research from K-State's John C. Pear Horticultural Center has quantified the effect of controlling grasses around newly planted trees. K-State horticulturist Ward Upham discusses the details of that research and its findings. Ward, as we think about getting trees off to the proper start, there's been some research done probably about 20 years ago now that really looked at whether or not controlling grasses around newly transplanted trees made a difference.
Yes, it sure did. So what we looked at were actually 5 different treatments. One was just looking at bare soil, and then we looked at mulched areas, and then we looked at 3 different grasses that were allowed to grow up to the tree. Those 3 grasses were tall fescue, Bermuda grass, Kentucky bluegrass. So what we did when we controlled the grasses is we kept that area bare or mulched out to 3 feet from that trunk. The others were allowed, of course, just to go right up to the trunk.
And you went with a couple of trees we would find in Kansas.
Yeah, eastern redbud and pecan seedlings. That's what we started with. Just wanted to get a little bit different types of trees and see if we got the same results.
The choosing of the eastern redbud seedlings and the pecan seedlings, any logic there?
The eastern redbud seedlings, they are hard to transplant. They are a difficult tree. Some people call them dead buds just because they are difficult to transplant. And so it was chosen just because of that.
And how long of a study was this?
So this took place over 2 years. So you did your planting, and then you took your data after 2 years. And we looked at a number of different things. We looked at caliper and top growth, the whole weight of the tree, and then the leaf area and leaf weight. And so that would tell us how well that tree is going. We didn't look at height. That's not really a good measure. If you have an idea of how much leaf area there is, that means there's a lot of photosynthetic tissue out there, and that's going to affect how quickly that tree gets established and grows.
So what were we finding then? What was the overriding message?
So first of all, between the bare soil and the mulch, there was no difference. It didn't make any difference at all. Now, if I were doing it, if I were planting a tree, I'd mulch because it's a real hassle to keep that soil bare out to 3 feet. And so no difference there. But then we looked at all the other stuff. The caliper, what we did is take the diameter of that tree 6 inches above ground level. For the mulched and the bare soil, it was always better than if it had any type of grass. Now, Bermuda grass was more aggressive than the other 2. The other 2 are Kentucky bluegrass and tall fescue. Those are cool season. That warm season grass was a lot more aggressive, and therefore we got a bigger change if you had the Bermuda grass. So if you kept it bare, it was a lot better than Bermuda grass. The other 2 are significant difference as well. So that was caliper. Then he took the top growth. So he cut it off at ground level, and then he just used a hanging scale so he can get the weight of the whole thing. And again, it's the same thing. If you had bare soil or mulched, you had much better growth than if you had grasses growing right up to that tree. And then the last thing was that leaf area, leaf weight. Again, at least twice as good or twice as much leaf area if you control those grasses. So it really made a huge difference to control the grasses.
And the real takeaway here is the fact that we want to do this because if you get those trees through the first few years, much better survival rate.
Much better survival rate and much better establishment and top growth as time goes on. So those first few years are critical in getting those trees off to a really good start. And so it's something we really do recommend is to control those grasses right up to the trunk out to at least 3 feet.
In terms of the mulch layer itself, we normally do 2 to 3 inches, or was it more than that?
That's right. No, it's about 3 inches. What you want to avoid is what we call volcano mulching. Volcano mulching, you heap that mulch right up to the trunk. It keeps that trunk wet, and that's actually bad for the tree. So a lot of people will pull the mulch away right from the base of the tree just a little bit. Then the rest of it, about 3 inches deep would be about right.
Would we maintain this distance then after those 2 years? Is it important to continue to keep the grass away?
I think it is because what people often do is use a weed whip to control the grasses around there. And if you let that grass go right up to the trunk, you're going to injure the trunk. And so I think it's a good idea to continue to control those grasses. Doesn't have to be all the way out to the drip line of the tree, but especially right next to that trunk, it's important.
That's K-State horticulturist Ward Upham with information on research from K-State's John C. Pear Horticultural Center on the effects of controlling grasses around newly planted trees. And that'll do it for this edition of Agriculture Today. For Samantha Bennett, I'm Jeff Wickman. This is the K-State Radio Network.